Hi, this is Eric, and I'm coming at you from the branch. Today, there's not going to be any frills, no special effects. Actually, all I'm going to do is talk about this economic crisis that we've got, the bailout plan, and try to do it in just plain, simple, logical terms. Now, a year ago, I started talking about a way to get us out of this mess that didn't involve $1 trillion, just some good old country logic. Nobody wanted to listen to that, and now we've got a big mess. Now, what I want to do is show you the plan and show you that it can also get us out of this mess. Now, this is not some big economic spiel. This is just going to be plain and simple logic. As a matter of fact, rather than go off on tangents in one way or the other, I'm just going to read from the plan, if I can bring it up here, and I want you all to think about it. And look at what Congress is proposing, the presidential candidates are proposing, the Fed's proposing. Everybody wants to throw money at this. Throwing money is not a good idea. Look at what's happening just today in the markets as far as the value of the dollar and the price of oil. This kind of spending is not good for the economy. Now, that's not to say we're not going to spend money, but we don't have to spend that much money. So let me give you a plain and simple plan. If you like the plan, hey, go out there, tell your congressmen, your senators, the political candidates, call the media. If you don't like the plan, you haven't lost anything. But at least hear me out. Let me get my specs here. Being an old man, got to see what I'm reading. Okay, now this is going to be a little simplified, but here's the general idea. We got to stop the economic breakdown that was caused in most part by the subprime mortgage fiasco. In other words, people being given loans to buy houses that they really couldn't afford. Next, we can't let the reckless lenders completely off the hook for their actions. But in my plan, they get more than the 30% they'll get from the government. They can actually get back 60 to 70% on many of their bad investments, and that way stay in business and give stimulus to the housing market and to the economy. But most importantly, don't put U.S. taxpayers completely on the hook for lender-borrower actions. We can't afford it, folks. We don't need to be there. We got our own problems. Okay? Next, we got to keep people in homes rather than letting foreclosed properties stand empty. And I just saw in the last couple of days we're over 9,000 foreclosures a day. Millions, that's millions of houses are being foreclosed on. Those houses are standing empty. No wonder we have a crisis in the housing market. Okay, next, we have to stimulate that housing market, and by doing that, we're going to stimulate the economy. Now, how do we do all this? Okay, first, immediately stop all bank-owned foreclosures that are currently in progress. That's right, just stop them right where they're at. Okay? Now, what we want to do is eliminate those foreclosures from people's credit records. Now, there are and I'll get to why. There are properties involved out there in these foreclosures at virtually every price range, from $50,000 homes to $5 million homes. Okay? What we do is we require lenders to work out deals with homeowners that would be or are under foreclosure for, let's say, a $300,000 home, to put them into a home that's a $200,000 home. Won't be as much house, but it's a house they could afford. And you do this by just applying the old lending criteria rather than, give them whatever they think they can afford. Go back, and so in this case, let's say somebody that's in a $300,000 home can really afford a $200,000 home. Okay? Now, we give them a choice. There's lots of $200,000 homes out there. You take them around, you let them pick one out, and we put them in the $200,000 home. Now, the lender keeps a customer paying for that $200,000 home that now those people that were in the $300,000 home can now afford, and can afford to make their credit card payments, so you don't have all the derivative fallout from credit cards that we had from the housing market. And we do that all the way down the line. So you take people from $200,000 houses and put them in $175,000 or $150,000. Give them a choice, but keep them in a home that they can purchase, and a home that they can afford to live comfortably at, in a decent loan at a decent fixed rate. Okay, we clear out all mention of foreclosure in their credit so we don't screw up their credit and keep them from being able to buy houses in the future, again, in order to stimulate the housing market. Now, we do this with all homeowners with jobs, etc., that would otherwise have qualified for the lower priced housing, which at the current housing market values will give them more house than they would have gotten otherwise. Homeowners, most of them will move down slightly, but they at least stay in a home. The taxpayer will be on the hook for those people that never should have been given a mortgage, but even that liability can be mitigated by a stimulated housing market, as we're going to talk about here. But again, we move everybody down. Okay. What are the benefits? By moving people into slightly smaller houses or less expensive houses that they can afford, rather than evicting them completely and letting all homes stand empty, the U.S. taxpayer has one less empty house to buy for each one. The lender gets a paying customer for their efforts. Less empty houses increases the demand, thus stimulating the housing market and thus stimulating the economy. And it decreases or stops the derivative effects on credit cards. These actions result in high-end housing, will result in the high-end housing that the U.S. taxpayer will end up with. Obviously, if we start at $500,000 houses and move everybody down, we're going to have the $500,000 houses out there. But as the housing market is stimulated, it gives value to those houses, and we're going to get more money returned for those than we otherwise would have. But we wouldn't have paid for the massive amount of houses below that, because we just moved everybody down and let the people that wanted a house keep paying for their houses. Okay? So instead of $1 trillion or 700 billion or whatever that number is going to be, we may be out of this for 100 billion or 200 billion or 250 billion, considerably less money than if we just went and bought all those bad debt and let all those houses sit out there empty. Now, a really smart mortgage investment bank would take this methodology on their own and build up their paying clients, now in slightly smaller homes, while their competition took the government's 30 cents on the dollar and then waited for the housing market to resurge before they could begin making profits. So how do they do this? Well, you get with somebody like RE/MAX, and you say, look, RE/MAX, here's the people that are in these houses, say that $300,000 house, and here's a list of $200,000 houses that they would qualify for, that they could afford to pay. Go show these houses. When they find one, do the paperwork, and we're going to give you your 5% commission for taking care of all the real estate needs. And put the real estate people back to work. And then we give, $1,000 moving credit or whatever, moving assistance to people to help them get moved. And whether they use a moving company, that'll stimulate moving companies into business. It'll stimulate truck rental companies like Ryder, Budget, or U-Haul at places like this. And it'll start stimulating the economy, getting other people to work. They win because instead of taking 30% on their bad investments, they're going to get the 60 or 70% and keep an ongoing good customer. Now again, this is a simplified version of the plan. It does keep people in houses rather than having the houses sit empty, and it stimulates the housing market, ultimately the economy. Most of all, it takes the U.S. taxpayer off the hook for most of the houses out there that would have been sitting empty. Now this is just my 2 cents. You may think it's not worth a damn, but it's a hell of a lot better than what's being proposed. As a matter of fact, there isn't anything being proposed other than throw money at it and give them money for their bad debt, and then sooner or later maybe sell it if the market comes back. We can't wait for that, folks. We can't wait. All right? Now, those of you that know me know this is a plan I've been pushing for over a year, mostly on deaf ears, as a way to prevent the meltdown we saw in the financial markets. Oh well, but the same methodology will help us get out of the mess by stopping foreclosures, keeping people in houses, and getting mortgage banks 60 to 70% on their bad investments instead of 30%. Think about it. Put it through your brain. This part is not hard to understand. We don't have to make this hard to understand. If you agree with me, fine. If you don't, fine. But at least let it get you to thinking, and let's think our way out of this process instead of 100% just spending our way out. Because essentially what the government's going to end up doing is have you to smile, bend over, and spread your cheeks. We don't need that anymore. That's my 2 cents. Thanks. Bye.